Okay, and in this week's Financial Acumen podcast topic, today's topic is what are the different stages of a capital raise and the benefits from each. We'll focus a little bit more on venture capital because our very esteemed guest, who I'm very excited to introduce, is Jahn Karsybaev, a former technology executive at Fortune 500 organizations. He's an experienced serial entrepreneur. He's had 2 exits and angel investor. Currently, he is a co-founder and managing partner at Big Sky Capital, a $20 million fund investing in enterprise SaaS. Jahn holds degrees from the University of Montana, NSU, and Harvard Business School. He is the founder of the Ivy podcast, where he interviews global executives, including the president of Microsoft and CEO of Deloitte. Jahn is an experienced board director and advisor, and currently serving on multiple company boards. His expertise in technology and fundraising has demonstrated a proven track record with many global organizations. Jahn, I am so thrilled to have you on the show. This is a bit of turning the tables a little bit, right? The last time we were together in this type of forum, you were interviewing me. So I'm so thrilled for this, Jahn. Thank you.
Richard, thank you so much for having me. And indeed, turn the tables. When was that? Close to 2 years ago?
It was close to 2 years ago. And that was an awesome session. That was an awesome session.
So I appreciate you doing that as well.
No, absolutely. And thank you, Jahn, for being on the show. As always, you're very gracious. All right. So, Jahn, let's get into it. Maybe a couple of minutes on each. As we know, each stage of a capital raise serves a specific purpose and should align with the business's growth trajectory and financial needs. So, Jahn, just if you can take a couple of minutes each, what are the main stages of a capital raise? We can start from seed capital and work your way through.
Yeah, absolutely. And when I think about fundraise, there's a lot of similarities between fundraising for your startup as a startup founder and also fundraising for your fund as well. And in a nutshell, those are very, very similar. And, there's a lot of misconception that, those are completely different processes, different stages and different, just overall approach. But at the end of the day, especially at the early stages, everyone is pretty much selling themselves, selling their vision, selling their story. So I just wanted to lay that foundation from the very beginning, because I've been on both sides of the equation. I've gone through the multiple fundraisers for my previous startups. And that's actually how the whole story for us getting into VC space was born, because through that journey, there were a lot of lessons learned, a lot of different experiences where I've said to myself that if I was ever on the other side of the table, I would do things a lot differently. So that's just a little bit of a background from that standpoint. But essentially, the fundraise, it really starts out with just you laying out that vision, laying out that strategy, and really documenting where at the end of the day, what's the most ideal outcome, and just whiteboarding that in front of you so that you visualize what would be the approach, and also most importantly, coming up with that initial list of your closest network, your closest connections, your closest friends, whether that's friends and family or whatever the case is, and really targeting that. So it seems like a daunting and large exercise, but you can keep that in very small chunks. So that's what really helped me not to get overwhelmed and take that first approach and come up with a full list of here's my vision, here's where I want to go, but here's some of the actionable small steps to take as part of that first phase.
Got it. Okay. And so that's the first phase. So, the entrepreneur who's got to, raise seed capital, just talk a little bit about that, the when, who, and typically how for seed capital, and we'll start to progress to the different types of capital raise, like startup early phase, series A, B, C, and then potential to venture capital. So just tell us a little bit, maybe a minute or two each on each of those phases.
Yeah, absolutely. The pre-seed, or just, anything from drawing on a napkin to actually building some type of a version of MVP is usually considered, pre-seed stage. And every founder during that stage, what we like to call, should focus on the triple F, the friends, family, and fools. So at the end of the day, you just go after that, what I've initially mentioned, your very closest network, very small checks. And that's where I started as an investor. I've been investing as an angel for quite some time, writing very small checks, anywhere from 5,000 all the way to, 50K. And during that stage, it's really all you just believing in the founder. There's nothing. There's absolutely nothing. It's all based on trust. It's all based on that relationship. But you as a founder, you really should also be very careful and diligent who you take money from, because there's a lot of inexperience in that stage. So you need to be very careful setting up those expectations up front, that it's a long-term game. It's not overnight. It's not a quick win. We got to be in this for a very, very long period of time. So that's very important, because I made a lot of mistakes during that stage, just taking money from whoever actually would listen and who would give me, any amount. And that sometimes backfires, because there's just the mismatch on the expectations.
Got it. Okay. And then you get past seed phase, you start a company, you're still trying to formulate a market, you haven't got your finances in order and so on, right? Or you haven't proven the profitability model or cash flow model. So then you go to start up an early stage capital. Tell us a little bit more about that.
Yeah, once you get some type of a product out to the market, well, typically it's an MVP, it's a solution, or it's a product that's with enough features to demonstrate to the market potential clients that this is the type of solution that I've built for the problem that they're experiencing. So with the money that you raise during the pre-seed, typically anywhere, from 50K to 200K, probably, maybe even less than that. That's enough to build something and develop a go-to-market strategy, the GTM. So that once you go to that and you see some type of validation, the indicators from the market, yes, there is an interest for this type of product, that they actually are interested in, potentially down the road purchasing something like this. That, there's various indicators that tell us as VCs that there's demand, that there's interest. For example, there's pre-sign-up sheets of people who are, actually, interested in the launch of this particular product. Or there's some maybe LOIs, the letters of intent, that companies would sign and would just give it to you, saying, yes, if you actually do build this full-fledged product, we would be very interested. So those things play into that transition from pre-seed to seed stage, because seed stage is what I would consider something that's already post-MVP. That's where my fund focus on. We focus on that seed stage, maybe transition between pre-seed and seed, because we're able to see those indicators of a product market fit, that there is maybe a little bit of revenue that's starting to get generated. And this post MVP, that the product is out there, that something is out there that the potential clients can actually already see, that you can run some demos, you can actually show the potential capabilities of the product that you had built. So that transition from pre-seed to seed stage, during that phase, you would go start approaching maybe more experienced angel investors, maybe smaller funds, smaller VCs. And you would actually tell that story, that here's how we've transitioned from the pre-seed, where it was just nothing, and now we're able to demonstrate the market fit. This is why we need to raise a little bit of a larger round.
Got it. Okay. And then, the fancy series A, B, and C. Tell us a little bit about those and where those play in the life cycle.
Yeah, those are what we call growth stages, especially the stages A and, the series A and B, because during that stage, once you raise, the seed round, you really focus on just the monetization, the business development, and full product out there. That's the main focus, is on that, to generate as much revenue as possible, so that you show the trend of growing MRR or ARR. And at the end of the day, you show the trends that there is demand for your product, that in order for you to scale from, let's say, 10,000 ARR to 100K, this is why you need to raise this round. Because you can continue growing at the pace you're at, but in order to graduate and go from different stages, you need that additional capital to hire more people, to build the product, with additional features, to add more sales, team, the marketing, and so forth. So that's really the message. That's really the story that you're telling, transitioning from that stage to Series A. And it varies industry by industry, and also from, time in the market, what constitutes the Series A. It all depends on the metrics, on the numbers specifically. But typically, as you start generating pretty decent amount of ARR, then you can actually consider that a Series A, because at that stage, you only talk to institutional level VCs, and VCs have very specific metrics that they would evaluate your company based upon that.
Right. And then just taking that further, when we use the kind of term VC, the venture capitalist, is the ultimate goal, Jahn, an IPO?
It's one of the goals. It's
Okay.
definitely one of the goals. It's a vision that a lot of us have.
Yeah.
But it's not necessarily the only vision as well. And these days, I see a lot of founders who are so into that vision, who are so into the problem they're solving, that they don't necessarily want to go some type of exit. They want to build a generational thing, which I respect a lot, because this is the company that I'm building with my fund. I don't want any type of exit just yet. I want the generational thing. I want my kids to be involved in this, in what I'm building. So I definitely, that resonates with a lot of the founders that I'm talking to, that this is something, very long term, that yes, potentially there is an IPO, some type of exit, but that's not necessarily the kind of the ultimate goal as well.
Got it. Okay. And, some entrepreneurs, John, will choose the debt route rather than, raising equity capital or so forth. Tell us a little bit more about, the when, who, and typically how of the debt route. Why would you choose that? Why would that be a consideration? And what's that route?
Yeah, there's a lot of motivations behind that. And typically it could be at extremely early stages as well, where you could take on a loan, such as SBA. I see that every day, where the terms are probably a lot more flexible, and it's a lot more streamlined process to get that funding, where you know what to expect. You fill out an application, you show your track record and all of that great stuff, and then you get some type of a loan. But you also need to be able to demonstrate that you are capable of paying that back. And a lot of the instruments that we use in venture capital are also a debt instrument in a sense. For example, a convertible note that, typically the early stages would go through some type of a safe route. But then when there is a price round, when we're able to assign the valuation to a company, we would go through what's called a convertible note. Because at that stage, we know the valuation of the company, and we know that at this particular milestone of a valuation or revenue, our investment will convert to equity. And if it doesn't convert, then the debt is due to be paid back. So there's different vehicles, different ways, and different motivations to do that, but it also all depends on the founder's confidence and track record to show that there is capability to pay that back if they don't want to essentially give up the equity in the company. So those would be some of the examples of how would that be structured.
Got it. Okay. And John, when does or when should entrepreneurs potentially consider a PE investment?
Those are very later stage. Those are
Yep.
even beyond growth stages. Those are past the Series A. Because at that stage, when you're talking to private equity and you're talking to public markets as well, that already you're setting yourself up for some type of a exit as well, for some type of an IPO, some type of M&A activity as well, where the private equity, that's what they specialize in. They have those relationships, they have the infrastructure to be able to pull all of the resources together to essentially package you for some type of a transaction, whether that's the IPO or an M&A or exit to another much larger organization. So those conversations would start much later stage, Series B and beyond. And that's where you actually would hire, specific bankers that are capable of structuring that whole, because it's a lengthy process and you got to start it that way in advance.
Got it. Okay. All right. That's great. Jahn, thank you for that overview. Now we're going to get into the real meat and potatoes, the nuts and bolts now. So I'm going to consider you and obviously Blue Sky Capital as VCs for this conversation, right? So for the purpose of the conversation, what do you look for in businesses before investing in them, Jahn?
So great question. And we talk about this a lot between me and my partner, because there's two variables that we strongly consider. Obviously, the team itself, the dynamics of the team, the backgrounds of the team, just the overall pedigree of the founders. Very important, because at that stage, that's what you evaluate, that's what you underrate. That goes unspoken. The same importance of an element is our ability actually helping the company. We take a very close look at that in the extremely early stages and evaluate if we can help, and if we feel like we can't, how can we help them? Because for us to write the check, it's one thing, but money is a commodity. And for us to compete with other VCs, we have to, demonstrate that, that unfair advantage that we have as a fund, and what type of value we can provide to the company, so that it's not just a financial support, It's a lot of other things that we could bring to the table, such as the introductions for the business development. It's the technology, from the software engineering, architecture, so the cybersecurity and all of that stuff. We're very strong in that. From the standpoint of just overall the marketing and the branding, where we have the platform to be able to amplify the voice of that company. So things like that play into a very serious consideration, because if we don't see those synergies, that we can't actually help you, then there's really no point, because at that stage, then it would be just us writing a check and just sitting and observing. And we definitely don't want that. And it's, I know that's not a very healthy relationship as well.
Got it. Sounds, Jahn, as well as those indicators that you also invest in certain industries. You're basically looking at certain industry. Is that a fair point? That, one of the things you're looking for is the overall industry as well as the few points you just mentioned.
Yeah, and we're industry agnostic as a fund.
Got it.
We focus on our core thesis is enterprise SaaS, B2B software, because we understand, that's our experience. We understand the semantics of building software for enterprise, selling software for enterprise, and just overall how to scale within the enterprise world, how to build those relationships, how to sell, and how to market that. So that's why we focus only on enterprise. And the industries, as far as what we target, we actually, by some type of coincidence or whatever, what's going on in the markets, we see a lot of activity in different verticals, such as cybersecurity, health tech, fintech. Those are very, very active, especially in this year. So we've made several investments in those verticals ourselves in recent times.
Got it. And so sounds like hot areas of business. All right. You mentioned also a compelling story, Jahn. You also mentioned earlier that it seems that there's some sales or tech advancement, right? I mean, they're not early stage. There's some proof. I know in the healthcare industry or so on, maybe an FDA approval of some sort, but in your space, there's got to be some tech advancement and also a good reputation.
Absolutely. Yeah, it's at the end of the day where, the reputation is what matters all across, for us as investors, for the other side, for the founders as well, because the track record and the background and the reputation, definitely speaks for itself. And anytime, especially when we think about how we can help the company, and if we can, it's all based on the reputational background or the history, that if I've made that introduction, let's say for you as a CFO of a larger organization, and I'm telling you, Richard, there's this company that's doing something incredible, you should definitely take a look at that. And for you to go through that exercise, allocate time for that, and then really actually seeing, yes, this is legit, then this is also the kind of the indicator that in the future, as we come across other deals, it's part of that reputational kind of aspect of this relationship building.
And two other things, Jahn, thank you for that. And two other things, potentially their understanding of the cost of capital, because that in my travels, when you've got founders, entrepreneurs who kind of go this route, they may or may not understand that there's a give-get for venture capital, right? And so the understanding of that cost of capital is extremely important. And potentially, even I've been in companies as well, the speed to IPO as a strategic point is important as well, Jahn. So tell me a little bit more about those two.
Yeah, and that's it takes a special experience, a special talent of a founder to even have that vision, that long term of a vision, and to say that this is where I actually want to take the company. And the path to the IPO, it's actually getting longer and longer. We see that in the news every day, where it used to be 5 to 7 years. Now you've seen 7 to 10 years. So the process and the journey gets a lot more extended for valid reasons as well, because the company is a lot more profitable, a lot more viable, and there's just probably no specific reason for them to even go public. But at the end of the day, that's also that self-awareness aspect of a founder, to also recognize, to say that, look, I have the experience and capabilities to take the company to a certain level, but then I have that self-awareness that at a certain stage that I may need to actually take a step aside and bring somebody else who is a lot more experienced. running a company, so let's say from the Series A to the Series D, because at that stage you actually all, it's a conglomerate, it's an enterprise. It's no longer a little startup that you started in the, in your bedroom. So when I hear things like that, to me, that's a great indicator of a very self-aware and mature and experienced founder. And those are some of the things that really tick off the boxes on the checklist.
You have hit a massive point, Jahn, because again, in my travels over the years, it's called founder syndrome. We all know that, where, just understanding that you've got to a certain point, you've got the vision, you've taken to a certain point, we understand it's your baby, but now you need some professional management and assistance as well, right? And being able to let go is critical. And so that self-awareness part is absolutely, to me, is one of the top 2 or 3 tenets of that next phase of growth,
Yeah, 100%. You nailed it on the head, because we also talk about the role of the VC, right? For us as who we are at the end of the day. And there's 2 things that really come to mind: is psychology and being that mirror to the founder. And because, there's a lot of things, of course, that we can do, but at the end of the day, if I can be that mirror, if I can be that almost that mental support to the founder, and to also show them that, look, these are some of the things that you're not good at, and we both need to recognize that from both sides of the equation. And if you can have that very healthy dialogue, especially early stages, that the relationship is there.
Absolutely. And it's important to preserve the founder culture and that vision of entrepreneurialism. And it is a balancing act, because when you start to bring on new people, you bring the operators, you bring the process people, etc. It's a striking balance between maintaining that entrepreneurial spirit and process and administration, right? Because that could go the other way when you're trying to grow a company, right?
100%. You nailed it on the head, because then you could be just focused on completely wrong things as the head of the company. And I see that a lot. I see that I catch myself a lot as well. So that's, that resonates on a lot of levels, what you're talking about.
Absolutely, Jahn. So, Jahn, how do you value a VC investment?
You mean evaluate?
Yes, value. I mean, in terms of you're going to go and make an investment, what's the kind of key things you look at when you're valuing? Because obviously it's seed stage and maybe a little bit more mature. Things may have been completely proven, and there's a win-loss ratio, and there's risk and opportunity involved in this equation. But when you're valuing, just the high-level kind of thought process that you go through when you're valuing a company.
Yeah, absolutely. And it's we have a pretty well documented process in terms of evaluating the company, and also just going through that due diligence process, because it needs to be, SOP, and it needs to be checklisted as much as possible, but there's a lot of variables that you can't quite account for. So as you mentioned, the early stage investing, a lot of that is based on the founder themselves and based on our ability to help them. But there's also a lot of variables that we take into account, such as, those very initial indicators of product market fit. Those are very important, because we would also, talk to those pilot customers as well, or the customers that actually did sign on. We'll spend a great deal of time talking to them as well, because we have that project management experience to be able to understand the importance of that very initial feedback from the customers, and how that shapes your product roadmap as well. Because we, myself included, some of the lessons through the early stage company growth that I've encountered is you get so bogged down and you're so in love with the product that you're building, that's all you focus on, and that's all you build, neglecting the most important aspect of that is that initial customer feedback and what is actually missing and how to prioritize certain features. So that's very important. Those go into the conversations that we have as a VC. And during those early stages, especially when you're transitioning from the pre-seed to seed, there's not a lot of metrics to evaluate from the revenue standpoint. Of course, if there is, it's great. Then we can apply certain, methodologies such as the DCF, the discounted cash flow, to be able to calculate certain valuation of a company. But a lot of times there isn't. So we have to get very creative in terms of how to evaluate the company, and also take into account some of the, just the overall growth trajectory, and how long does that take for you to close that particular account size? And then actually, how do you get access to the decision makers? What is the process that you go through? And can you build a sustainable process to be able for somebody else to follow that checklist and sell and go through that business development lifestyle, so that you're not the bottleneck. You're not the only one who is capable of doing that. Those are some of the things that are very important during those early stages.
Got it. And so, the VC world, it's not a secret. You can read it anywhere. Jahn, there is a fairly low probability of success, but when there is a success, it is usually a good one, right? And the quotes are typically 10%. 1 in 10 of these investments work out. How do you typically structure a deal? Because there's obviously a risk reward here, right? I mean, you've got to kind of be able to protect your downside as well as share on the upside as well. And we'll talk a little bit about the other side, about them and their equation for upside. But how do VCs typically structure the deal?
Yeah, and you pointed it out correctly that we're in the business of risk mitigation. We're in business of risk management. We assign different risk categories and different risks from a standpoint. There's a founder risk, there's a market risk, and there's a product risk. So there's different categorization that we go through, at least that mental checklist of some of the things that we account for in those stages. But at the end of the day, it's also a policy in the sense that as a VC, I'm going to invest in 10 companies and 9 of them are going to fail. And that one that I find is going to be the fund returner. I don't like that mentality personally, because then it just puts you in a mindset, okay, that everything is just going to suck and you just got to find that one. For me, for my mental state, it's not a good thing.
Right.
I have to focus on that, 10 out of 10 are going to be winners. And I try to put that hat on, especially every time I meet the founders. Is this a world-class founder? Is this a once-in-a-lifetime generational founder? Is this a category-defining product? So when you see that, and after every call, it's like, do I have that wow factor? And if I don't have that wow factor, then I got to look at other things in terms of, what will keep us going, moving this forward. So those are just some of the things that I have to be very cognizant of, because I'm in the business of, capital allocation, capital management. And when it comes to just selecting the winners, I want to make sure that I have the process, I have the infrastructure, I have the team to be able to select and help the companies that are going to be 10 out of 10 and not that 1 out of 10.
Absolutely. And so when you structure the deal, is it typically, you mentioned a convertible note sometimes, is it usually preferred equity? I mean, how does it typically work?
Yeah, those are very standard. The convertible note is a standard agreement that we typically sign, especially in the seed stages, because that's exactly what it is. It's a convertible note. It converts at a certain milestone into equity. That's in the very simple terms. And we structure those deals from that standpoint. But there's also in the earlier stages where we talk about the pre-seed stage, where there's not a lot of revenue or maybe no revenue. We typically go through a much simpler, which is a safe route. And safe is, it started with a Y Combinator. And it's very simple, where you assign a discount that us as VCs are going to get from the future price round. And there's a valuation cap that this particular valuation, this is where our discount applies. So very simple. And it's great for the founder, because at that stage, you don't have to worry about the valuation of the company as well. And it's very preferred. I recommend it to the founders a lot, because they would get bogged down into the convertible note and all of the terms. But then in reality, it just needs to be a lot simpler at that stage. And yes, every investment that we make as a VC, we are a preferred stock at that stage, and the founders and the team, they're common stock. And there's a lot of peripherals that go into play, especially when it comes to just the details of the term sheet.
Right. And Jahn, what may be a good idea is, you structure it that way because there's a fund, and that fund has investors, whether it be, personal or institutional, etc. Just let's kind of educate the listeners about you're responsible to a group of investors as well, right? And so this risk return equation has got to work for various parties, including the entrepreneur and the founder, which we'll talk about in a minute. But just say a little bit about how that kind of process works.
That's exactly that, Richard, and thank you for highlighting that, because at the end of the day, there's also that misconception that VCs are just a bunch of spoiled rich kids that running around and just writing checks left and right. But at the end of the day, we go through the same fundraising process. Maybe we just answer different questions. But at the end of the day, I have investors who are called LPs, the limited partners. those folks that invest into our fund with the exact same underwriting criteria that we would underwrite the early stage startup, because we're brand new. We only have a certain amount of track record from the previous life as well, and it's all based on us as the fund managers and our vision where we want to take this and how we're actually going to win. So the LPs, the investors that come into the fund, they would invest, and a lot of them also want to be very active in terms of the due diligence process. So how we select deals. So the portfolio management aspect. Once the investment is made, how we're going to come together and actually help those portfolio companies take the board seats, become the advisors, become the mentors, and so forth. So those are the dynamics of that relationship building with our investors, our LPs.
Absolutely. And, again, back to the risk reward equation, these are investors who are putting their money in an adolescent stage company, typically early stage. All right. Who knows in terms of the S curve where that would be, right? Because it could go this way, it could go this way. Our hope and trust is it goes that way, right? And they're looking for a return on their capital. And typically, in the VC space, over a horizon of 5 years, you're looking at maybe between 25 and 40%, internal rate of return on, or maybe 10x on their capital. But again, it's a very early stage, so there's risk involved in that, and so your investment criteria is very, very important, Jahn. So on that, let's turn the table on the entrepreneur side. What's the upside for the entrepreneur or the founder?
The upside is the ability to scale a lot faster, a lot more efficiently. And if you have built a product and the company that you don't need investors for, that you're in great shape, because then you have the options to be able to say, look, I can grow at the current pace, but in order for me to 10x or 100x, I need the additional capital to replicate what I had already built and bring on, the 2 times more developers, 2 times more sales engineers, and 2 times more of a marketing team, so that when I take my revenue where it is right now and 10x that by taking on that outside capital from the VCs. And it's hard. And if you're in that position, you're great. You're a winner. That's what we look for. I look for founders that don't need my money. And that's usually a great indicator. But those, I understand how difficult that is. It's a monumental task. The other side of the equation is for you as a founder to be extremely diligent in pre-qualifying the investors that you allow into your house. It's easier said than done, because a lot of times you may feel like, especially in current times where it's very difficult to fundraise, it's completely different dynamics. There's the VC winter is real. And for you to pre-qualify and really see how you guys match up in a sense, just from overall just personality match all the way through their track record as a fund, how they've been able to help other companies and doing the homework, the reference checks, talking to the portfolio companies of that fund. Those are, you should do that as a founder. And there's nothing wrong for you to ask of the VC, say, look, can you connect me with some of your portfolio companies and see how you guys operate? And if you demonstrate that, to me, that's a great indicator. But for a founder, it's just very important, because it's not dating anymore, it's marriage. If you take the investor's money, it's a very long-term game. And if you don't like working with each other, oh man, it's going to be painful.
Absolutely. So Jahn, because you've been on both sides. So I want to really, go deep on the point, and you've led into it perfectly. So what are good questions for an entrepreneur to ask a VC firm as they're evaluating the VC firm? You mentioned a few things just now, which are completely right. Let's give them specific questions to ask, because you've been on both sides. You've evaluated VC firms as well, right? What would you say are the most important questions to ask?
Great question, and I have a lot of those, because I've kind of gone through that mental, just lessons learned retrospective on what would I be asking of a VC, knowing what I know now as a VC. And some examples that really come to mind is in the sense, well, number one, from the pre-qualification standpoint, is what is your guys' sweet spot? What are you investing in terms of that particular vertical, and why is that? And why do you have that expertise? Why do you have that skill set? Do you have something internally? Maybe you LPs, or in our case, we invest in cybersecurity because we have LPs that are head of cybersecurity at Meta. head of cybersecurity at very large organizations. So we have that expertise. We can tap into that. So those are just examples of questions that you as a founder could ask. You could also you could easily calculate, but you could ask as well, what is the average check size of that particular fund based on the overall fund size? Because last thing you want is talking to a fund where you don't fit that criteria, and you'll be wasting your time pitching to the wrong VC. So you also need to take into account the semantics of the from the financial standpoint. The other questions is how much of a capital does the fund allocate for follow-on investing? Because yes, us as a fund, we're 70-30 or maybe 60-40, where we would invest 70% of the fund as initial check size, but we reserve about 30-40% of the fund as a follow-on, because we want to back and support the winners continuously. And that's why we get the pro rata rights in the term sheet saying, look, if we're coming in right now, we want preferential treatment in a sense in the later stages, because we allocate the capital to be able to do that. So you want to, as a founder, you want to hear that, you want to know that this is the VC is capable of continuously backing you. The other questions is from the standpoint of the value add of the VC. It's a very sensitive topic because the VCs are very, very good at screaming, in a megaphone, value add, value add, value add. We have that on the home pages all over the place, that it's all about value add. But give me examples of how you actually provided that value add beyond the check size. Just maybe give me a scenario where you actually came to the table with meaningful results. The other important, questions to ask is, what is their understanding of a board and the board role? And a lot of times, us as VCs, when we come on, we would take some type of a board seat, either the full-blown board director or a board observer or a board advisor, depending on the stage of the company where we invest. So for you to get an understanding of how they view that role is very important. Because a lot of times I see in VCs or other, investors is that inexperience as a board advisor, as a board observer, as a board director. And that's a challenge, because at the end of the day, you want to build a board around you who really understand the importance of the board and how to effectively run that. And those are some of the things that you have to take into account. So those are just some of the examples of just the questions for you as a founder you could ask. Of course, there's a lot more that you could get into in terms of their due diligence process, their decision-making process, and just how essentially they go through that evaluation, underwriting criteria. But those are just some of the things that really come to mind.
Love it. Thank you, Jahn. Golden wisdom bites. Thank you so much. What is the biggest mistake that businesses make when they seek fresh capital?
Well, I see a lot of those. There's a lot of lessons learned, even for me when I was fundraising, myself. And it also, it depends on the situation. Hopefully you're not in a situation where you're desperate and your back is against the wall and you're just, you're just running around and try to take on any capital that you can. That usually, you can tell that, and you can tell how desperate that is, the founder is. And rightfully so, there's a lot of different circumstances. So it's impossible to make assumptions. But as a founder, try to get yourself in a situation that you try to be as proactive as possible. Think longer term, that even if you don't need capital right now, focus on building those relationships with the VCs. Invest into that, because those are very valuable relationships. At the end of the day, even if you're not going to fundraise, VCs are extremely well connected in all spectrums of business development, business growth, business strategy. They have the ecosystem around them. So really invest in building those, cultivating those relationships, and consult with the VCs as well. Here's where I'm at. A lot of VCs are really, really good at certain aspects of, let's say, the GTM, go-to-market strategy, or pricing, or technology. Consult with them, build those relationships, and it will help you in the long run as a founder. So some of the mistakes that I see, founders are not investing into that. The other fallacy of the founder is also what I mentioned earlier, and I see that day in and day out, just falling in love with the product. Don't fall in love with the product. Don't fall in love with that, because that's going to change by the hour. That's going to change by the day. And just be very self-aware that you are not the only one that knows what the product should be. You actually should be the last one. And really invest into that kind of aspect of getting that feedback from the outside world, from the, the pilot customers and things like that. So those are just some of the mistakes that I see that, very easily fixed, but at the same time, could get you in a very big trouble. And then it's interesting to observe some founders that go through that fundraising and they get a little bit more comfortable, and then they start getting into like these extracurricular activities where you see them participating in conferences, traveling, focusing on the media, just that publicity, all of that. And it's you see that as well, and it's you need to be able as a VC to also have that relationship and say, look, focus on what's the most important. What's the most important at this stage? In my mind, for you as a CEO of a company, is hiring and recruiting. You need to be doing that number one, and the rest is you need to build that ecosystem and infrastructure for people to thrive in their roles.
Absolutely, I love that. Oh, and I love that. I love your part, because I have been part of organizations where we fell in love with the product, all right, in MVP stage, and didn't get the market research and the customer feedback correct, and we paid the consequence. So thank you for that, Jahn. Okay, so what should businesses expect post capital investment?
So once the transaction goes through, hopefully way in advance of that, you and your VC partner already rolling up the sleeves and working on certain strategies, such as the introductions or the business development, the technology piece, so the hiring and recruiting, so that way before the term sheet and everything, the wire actually goes through, there's a lot of activity already in motion. So I love that. I love that aspect, that it means we have a very healthy relationship. But once everything is, signed and all, the wire is done, then it's also getting very busy. Then really understanding what are the most important, what are the kind of the biggest problems that you as a company facing right now in this stage. And let's design, let's come up with a very tactical and actionable plan so that I can put my team together and just go start closing those gaps for you. So that should be the expectation, but that also should be way in advance of when the transaction actually goes through.
What about reporting, cadence, KPIs, board meetings? Tell us a little bit more about what to expect post-investment.
Yeah, those are usually part of the term sheet as well, that where you specify and you agree on at least the minimal frequency of a communication of you as a founder, where you will agree that at least on a monthly basis, you're gonna send the investor updates. Which I love when the founder actually does that themselves, and they come to you and say, "Look, I have this. Can I add you to my investor update?" I just absolutely love that. And then the board meetings as well, the frequency of that, the sequence of that, what is the structure? So those are usually part of the term sheet as well. And you also want to make sure that you don't overwhelm the founder with a lot of your requirements, and it's not necessarily a give and take, but it needs to be a conversation with the founder as well, in terms of, here's some of my expectations as a fund, because I need to be able to report to my LPs at this particular frequency. So I would expect either for you to give me that information or give me access to obtain that information from you, depending on where you at as an organization. So those are some of the things that have to be taken into account as well.
So Jahn, typically in these organizations, you've got the aunt who's the bookkeeper. Tell us what your expectation is, because you're reportable to others in terms of investors as well. But what are your expectations regards accounting, infrastructure, and reporting and so forth? Again, just knowing it's probably a few people, all right, and you've got very nuanced and basic books, probably QuickBooks if that. Tell us what the expectation would be from an accounting standpoint.
Yeah, and you mentioned that, because in the very early stages, it's total chaos.
Yes,
Not allowed. I guess for valid reasons to a certain extent, that the company is just focusing on just building and selling, where the infrastructure in the back office is not necessarily the top priority, which is fine. It's not a deal breaker, but at the end of the day, for the founder to be aware of that and say, look, let us get through these stages, and then it's something that's very important that we will fix that we will bring, let's say, a fractional CFO or somebody who is an expert in that space to be able to package everything for us. Because when we come in as an institutional VC, there's certain expectations for us to actually see the financial statements, see all of the, how the revenue is booked, how everything is actually recorded and tracked. Those are very important things. And it's the more organized that is, the faster our process is in terms of due diligence. And if it's not, it's going to take a lot longer. So it's actually in your favor for you as a founder to keep those things organized from the very beginning, because that is going to be costly, then it's going to be timely, that is going to be, just for you to, you can't ignore that for a very long time, especially if you decide to go on that fundraising journey. You have to package yourself. You have to package everything that will be very easy for the outside investors and everybody else to consume. So that's very important. And kind of to your extent, what you and I have been chatting about earlier, the importance of, just having somebody on the team that knows that space, that also knows what the investors are looking for, and just to do that way in advance so that you're not scrambling at the 11th hour, because then a lot of mistakes are going to be made.
Right. And it could be a significant investment of other people's money, Jahn, and you've got to be able to follow the money. You've got to be able to account for where the money went, where it's been invested, and so on, right? Because otherwise you could go sideways and a completely different way. It's very important. I've been involved in organizations like that as well, where there's been some significant money in for product development and so forth, and to find out where it was really spent between engineering, product development, testing and so forth, just as examples, was haywire. Not right. You got to be able to do that. So, we talked about, founders, we talked about their mindset, we talked about the psychology, typically visionaries, see opportunity in the market. Now, all of a sudden, post-investment, Jahn, we got governance and we've got accounting infrastructure, we've got administration. What's typically the most difficult mindset shift for entrepreneurs post-investment?
Yeah, that's a great question. And I think you kind of know where I'm going to take this, because it's building that infrastructure of a kind of the fully fledged organization, where you're no longer the small startups with just two co-founders and one or two freelance developers that are running around. You need, structure in place, you need governance in place, just like you said, and you need the reporting infrastructure in place as well. Because you as a founder, you need to be, especially in early stages, you need to be very well aware of every single dollar that goes in and every single dollar that goes out. Yeah. It boggles my mind when I'm talking to some founders and they can't clearly articulate how much money they're bringing in or what are they spending on and how much that's costing them. It's like, no, I'm the visionary. I'm focusing on the product, or I'm focusing on the other things. No, in those early stages, you need to be aware of every single penny that goes in and goes out. I'm sorry, but that's just, how I would operate. And I see successful founders who are capable of having that hand on the pulse to say that. And then bringing somebody in-house and understanding that you can't do everything yourself. That's, great characteristic of an amazing founder, to say, here's the area that I'm not an expert in, but I understand the importance of that. And I'm going to bring on that, let's say, financial expert or the CFO, who is going to be, not necessarily the full-fledged CFO, but they can grow with us within the organization. We can bring them on as a consultant, go through all of our books, go through that audit, and just do the self-audit on, even if it's not required at this stage. But for me, as a founder, I'd probably sleep better at night knowing that I've passed all the checks and balances and I've passed that internal audit, and that anytime somebody comes to me, I can easily produce that. I don't have to say, oh, let me go back, give me a couple of weeks to do that. No, at every single point in time, I can actually pull up a folder in Dropbox and send that to you. So those are just some of the things that how I would operate, and that's how I operate even right now in the fund. So those are very important things, but the most important is not try to do that everything yourself, because you will then lose sight of what's important, of what you really should be focusing on. It's just bringing somebody else who has that experience, and you have those working dynamics for you to be able to build that infrastructure.
Right, and Jahn, you raise a great point, because again, in my travels, post-investments, when you speak to founders and entrepreneurs that, okay, now we're up against potentially a plan, there's a forecast, there may be a budget, And, they have no idea what you're talking about because they feel as though it's a constraint. They feel as though, now they're accountable to numbers and other parties, etc. So my question before the last one here, and this is, I'm sure you got a lot of scar tissue on this one, Jahn, is in hindsight, when investments don't work out, what financial assumptions can go significantly wrong? When in hindsight, when you're looking at an investment that didn't go right, and we had a plan, we thought certain things were going to happen, what's the one or two financial assumptions that typically just went wrong, that we just completely got wrong?
Yeah, that's a $1 million question, and it's an ongoing learning journey for us as investors as well, to say, these are the retrospectives. These are some of the things that maybe we've missed. For me, the biggest fear is to get to a stage and say, okay, everything is going completely sideways and it's just not working out. It's not where it needs to be, especially when you compare the projected revenue versus where we are right now, the budget that we completely off.
Yes.
For me, the biggest fear is that time has passed and I have not been active enough to get involved and say, oh, well, we're at the end of the year and now we're just discovering that there's problems. For me, it's a failure as an investor, because then I haven't been proactive enough. I haven't been diligent enough. I haven't been professional enough to keep my hand on, just on the pulse all throughout that journey. And that, it's a failure on all rounds, on all sides of the equation, from the founders all the way to the investors as well. So the mental framework is just avoid that coulda, woulda, shoulda. I hate getting to the end of the year and doing that year-end analysis and talking about, we could have done this, we should have done this, we would have done this. That's just, that's my pet peeve. I go nuts about it. Even just for myself as an individual, as a professional, just avoid that coulda, woulda, shoulda. And those are just some of the things that we try to avoid from a standpoint of, this investment didn't work out, but that we are the ones who dropped the ball. That how did we not see the trend going downwards, and why didn't we address that in those early stages? Why did we let that happen? So those are just some of the things that, in a nutshell, as an umbrella of a lesson learned, that I apply to those mental frameworks and things, that the criteria that we use, when the transaction goes through, everything is signed, wire is sent. Okay, let's get to work. I don't want to get to the stage where it's now we were just dealing with all kinds of problems and we didn't see that.
Right. And so how do you see that though, Jahn? Let's say, you've got the aunt who's a bookkeeper, financial statements come out a month after the end of the month, or maybe 2 months, all right, maybe on a cash basis or whatever, right? And so being able to proactively monitor the progress. And what I've seen is, the biggest assumption misses clearly on the top line. I mean, your point before about, founders having their baby, and this is, this is my product. I think it's the greatest thing in the world, and not getting the outside view and continue overestimating the demand. For me, is probably the biggest assumption that can fail at the end of the day. But as you want to monitor this and be more proactive, Jahn, what are you kind of insisting your investees to give you, so you're not waiting to the end of the month or the end of the year and, reacting to certain things? What are you demanding at that stage so you can kind of monitor the progress?
Yeah, well, information is critical. And that goes even before that, for me to understand that we have that relationship, that you don't view that as a nuisance, that for me to reach out and it's a distraction. Of course, I understand the elements of when to take a step back and when to get involved, but also for us to have that relationship, for you to text me and say, look, I'm talking to this huge client, potential big deal that we're trying to close, but the deal keeps getting extended. That we projected was going to be closed in 2 months, but now we're in month 6. It hasn't been closed. Why is that? Are we wasting our time with this particular client, or we just don't know what we're doing? So those are some of the things that go into that play, developing that relationship with the founder, so that if the conversation starts with bad news, I know that the relationship is there. Because if you're just projecting, we're super close, it's going to be signed tomorrow, we're just going through the red lines of the MSA. Okay, great. But if it hasn't been signed, have you thought about why it's not going to be signed? And do you have a plan B, risk mitigation, that if it's not signed by the end of the month, what are we doing beyond that? So those are just some of the elements that I pay very close attention to. And just having that ongoing dialogue, ongoing conversation, that the founder also is very comfortable reaching out to me as a counsel and saying, look, this deal is not going through, or it's taking a lot longer. Let's sit down and talk and how we can actually, either pivot or come up with a different approach towards that. Same goes for the financial reporting, financial structure is, look, projections are projections. I don't pay a lot of attention to projections. And I'm sorry, they could be as glamorous as they are, but very rarely they actually come true. So it's great to have that vision, but at the end of the day, you also need to be very realistic in terms of when the actuals come in, and when, what's the difference between the book revenue versus that, something that hasn't even been collected. So those things are very important. And for you as a founder, you just need to, at least conceptually, to be aware of what that means.
Absolutely. Jahn, I would add to that. I would say, again, in my experience, the sales pipeline, looking at that and understanding that each stage of the sales cycle, to your point, monitoring when that particular prospect is taking too long, when we expect it to be a month, it's 6 months. But understand, having those real diligent conversations around that, I found is critically important at the early stages. It's typically demand that goes off, or the top line. Number two is getting to really what the unit economics are, Jahn. What is the true gross margin of the service or the product or whatever. And it's tough to say that, because that's really where the money's made. And typically when you ask founders about how do you really make money, you may not get the right answer, right? And so drilling into that. And then thirdly, of course, following the money with the cash flow, and understand where the money's in or out, But those are the main ones.
I need expertise like yourself in helping out startups and companies. It's a very complicated space.
I have quite a bit of scar tissue here, Jahn. So my last question, Jahn, what is your parting advice for businesses looking to raise early stage capital?
Start early, start way in advance. Don't wait till the last minute, because it's a very, very long process. And also understand how full-time of a job that is. It should not be treated as an extracurricular activity, because it's a very involved process. And it starts with you just having a very, very kind of watertight infrastructure for you to know every single dollar that goes in and goes out. What is the development you're working on? How do you prioritize all of the features that you're trying to develop? What is the sales pipeline looking like? And how long does that take for you to close a particular deal? What are the metrics of every particular size of the client that you're trying to bring on, the profitability from each one, and where's the sweet spot? So those are the things that you need to be very well aware of as a founder operator of the company, and that translates into the fundraising process as well, because you're going to get those questions. You're going to get the questions that you should be asking yourself on a daily basis as the founder and operator of your company. And if you struggle to answer questions in certain aspects of your company, either make sure you have the resource from your team who is capable of providing the details of that, or just go and get yourself educated and get yourself plugged into that space of your company, because it's the exact same process that you're going to go through the due diligence when you get the investors involved. So that's just kind of the advice from that standpoint. The other advice is really also what I've previously talked about, that pre-qualification of the investors as well. Don't get desperate. Don't get into a situation where you have to run around and chase every single investor that will take a meeting. Make sure you do your homework. Come up with that list and reasons why those investors are great for you and why they have that experience to actually help your type of company. That's very important. That's very important. I know it's very challenging, but at the end of the day, it needs to be done.
Jahn, thank you so much. This was tremendous. Wow, there's been some fantastic wisdom bites here for people looking to attract and early stage capital and what to expect afterwards. But this has been tremendous, Jahn. Thank you so much for sharing your wisdom and expertise. I've always loved you. We've had a great relationship over the years. You bring a breadth of experience. And I said, what I really enjoy about our conversation, Jahn, is not just the nuts and bolts of investments and finances and all that. You bring a nice kind of qualitative and psychological view to investing in business as well. And I love that because that is the big part. These are all humans we're dealing with, you know? And I love that part about our conversation. So thank you. Consciously,
That's awesome.
let's say.
Thanks so much for having me. You have a great platform for sharing that type of content, which I appreciate a lot, because there's not enough of that visibility in a lot of the things that you talk about, as a CFO, as a financial expert. And it's a space that's very intimidating, at least for me. Even during that at HBS, we had this financial class that everyone was just petrified on. But at the end of the day, it's something that you need to be aware of. So I definitely appreciate what you do, and much appreciated for having me on the show as well.
Thank you, Jahn. And you did a great job breaking it down. I know it can be intimidating, but I think you did a great job of, making complicated topics fairly simple. So thank you for that.
Thank you, Richard.
All the very best, Jahn. Take care. Love you, man. All the best. Bye-bye.
Thanks so much.
Bye-bye.